Welcome back to the Lance Roberts Show podcast. Today we're spending some time with Kevin Lenox, Senior Financial Advisor for United Capital. So Kevin, just for the break, we're talking a little bit about, kind of markets and the Federal Reserve and trade. The hope is that, we'll get a resolution on the trade deal, the Fed will cut rates, we'll get QE, and everything's gonna be great. And we're going to have this massive expansion in the markets, and a 10-year bull market becomes a 50-year bull market, right? That's the idea. One of the other differences that we haven't really talked about yet, we did talk about the fact that in 2009 you had this very negative sentiment for the markets. You had really a prime fertile ground to launch a bull market from. Bull markets don't start from, booming asset prices, booming confidence, et cetera. Bull markets don't start when everything is great, right? They start from when everything is super negative. Obviously, things are not super negative in the markets right now. So we're talking about this, but another difference between the current environment and that of what we saw in 2009 is what we're paying for every dollar's worth of earnings or corporate profits. I just did a study here recently, just published it, looking at corporate profits, actual reported corporate profits, not earnings, which are all kinds of manipulation, but what was reported to the government for taxes, corporate profits. Those profits before tax are the same level as they were in 2011. Corporate profits on an after-tax basis, same level as they were in 2014. So here we are, 8 years into a bull market, corporate profits are exactly the same level they were, 8 years ago, but yet asset prices are almost 200% higher. So valuations are another thing that we need to really pay attention to. What are we paying for expectations from quantitative easing and from the Fed?
Yeah, we're at 19 times this year's earnings, which there was a cut just in the last 6 months between expectations in the S&P 500 from 160 to 150, and nobody blinked.
Right.
And my guess is, and it's all stacked to the second half, the first quarter and second quarter just fractionally above first half of last year. But, like an Animal House, we're hoping the second half will really help our average. And I don't see it going that way.
Well, and we see this a lot is, when we take a look at earnings estimates, they're always historically high by about 33% on average. We see those estimates, and again, we don't pay attention to this, right? I do a study, every quarter looking at what the analysts said at the beginning of the quarter versus where they are now. And it's always interesting, every quarter we come in, it's like, hey, 70% of companies beat earnings estimates. Well, not if you actually use the original estimates. If you lower the bar low enough, yes, the majority of people are going to get over the, the earnings bar. I call it millennial earnings, which is everybody gets a trophy, right? We lower the standard, everybody gets over it, we give everybody a trophy, it's all good. The reality is that you take a look at the trend in earnings estimates going out to 2020. Those are too high. We're going to see those come down by about another 30%. And investors should be asking themselves exactly how much am I paying for those estimates now, and what if those estimates are wrong?
And that's why I contend there's too much faith in the Fed at this point, and global central banks overall, that they will always step in, they will always provide enough liquidity, and I just don't think, as you said before, pushing on a string.
Right.
I think we're kind of at that point. And debt saturation is so high now, and corporate debt levels are such that there's not as much ammunition to continue these buybacks, where corporations themselves have been the largest purchaser of U.S. stocks.
Right. Well, that brings up kind of an interesting question, talking about, and again, kind of tagging onto this valuation argument. We look at other metrics of valuation, price to sales ratio, we look at, price to EBITDA, we look at a lot of these other things. A lot of those ratios, right, these valuations estimates, et cetera, those are based upon outstanding shares, right? Sales per share, earnings per share. But the one thing that we've had here over the course of the last few years in particular is a massive engagement of stock share buybacks. And one of the things that happened during the tax cuts that we got in December 2017, we wrote an article in early 2018 talking about tax cuts are great for corporations. It's all going to go to share buybacks, which is exactly what happened. So, when we look at these valuation measures, we also have to take into account what would those valuation measures be without all those share buybacks? Because again, those valuation levels are actually much higher than they would be otherwise.
Yeah, there's a number of smaller, the second half of the S&P 500 that are kind of in the zombie status. And you've got these top 6 companies in the S&P now that count for the bottom 290. And those are the share buyback machines. And I think it's distorting the real picture of the stock market.
Well, I think it's a good point, and we're talking about, of course, Facebook, Apple, Netflix, Microsoft, Google, kind of the FANG stocks, and those have been a primary driver of the inflation of asset prices over the course of the last 10 years. We take a look back, and really a large chunk of the gains in the entire S&P 500 come from a very small handful of stocks. Yes, we did see rises in small caps and mid caps early on in the cycle, but small caps and mid caps, as we've begun to see this economic deterioration, have really begun to underperform because they're the most sensitive to these economic changes.
Yeah, so we were both in the business in late '99. And,
I remember that.
Before the tech bubble burst. And I remember specifically seeing the comment that the top 10 stocks accounted for 105% of the return in the S&P in 1999, and that stood out to me. That was I was year 2 of the CFA program, and that was one of those inflection points. It's like, that's kind of when the top is in.
Yeah.
And we're there now, and the bloom is coming off of the FANGs.
Right.
And there's increasing regulatory pressures starting to build.
Well, and when we come back from the break, I want to touch on just kind of a handful of topics that I think are worth discussing. Things like the number of unicorns that we have today versus what we've seen in the past. And you and I have both been through 2 major bull markets and 2 major crashes, both 1999 as well as 2008. In there, while people want to discount what we're seeing today, is like, oh, this time is different. There's a lot of similarities to what we see today versus what you and I have both been through in the past. We'll come back and talk with that with Kevin Lenox right after the break. Don't go away.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.